Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning, everyone. Hope everyone had a great weekend. We get started this morning. So this morning I'm going to start out and discuss goal setting. Then I am going to talk about some of the things that we financially should think about as we approach year-end, things we've talked about before. And then I'm going to talk about the financial markets, what's going on last week, this week, a tremendous amount of market news and things that can affect the markets, not just presently, but going forward. So this morning, year-end, good time to think about what went right, what you'd like to improve, and what you'd like to do differently, or perhaps new, or perhaps the same in 2020. Yeah, that's got a ring to it here. Felt like it was just 2000, turn of the millennium, and here we are 20 years later. Many of us can remember very well wondering whether or not the world was going to stop functioning, computers were going to shut down December 31st in 1999. So here we are 20 years later. But what hasn't changed is that in order to move forward, we need to keep thinking about what we need to do in order to be successful. Success is not something that happens by accident. Planning is a critical step in order to achieve success. Almost all successful people have a plan. If you listen even to successful athletes like Michael Jordan or Tiger Woods, they'll tell you the same thing. Tiger Woods, before he gets to a hole, he has studied that hole. He has visualized playing that hole and how he's going to play it today with this wind condition, with this speed on the green, with this placement of the cup. He has visualized in his mind, before he gets to that hole, how he is going to play that hole. Michael Jordan, before he gets on the court, before he plays Game 7 of a final, visualizes how he wants that final to end. Visualizes how he's going to play during the game. Visualize who he's going to guard during that game. Visualizes what type of shots he's going to take in that game. And visualizes the success and the victory after the game in his mind before the game is even played. So our job, as whether we're parents, whether we're spouses, whether we're investors, financial professionals, lawyers, accountants, doesn't matter. Whatever our goals are in the respective areas that we seek to focus, we need to be able to visualize what we want to accomplish in the year that is upcoming. Another important factor in structuring these goals is that many people fail to achieve their goals because they identify an outcome without also identifying the underlying motivation of that outcome. And that often leads to things on January 1st or 2nd, like sleeping in instead of heading out to the gym. So setting yourself up for a successful year means getting clear on what you're really going for and why you are going for it. Because the why is what propels you and what drives you towards that success. It's the why that motivates you. If you don't focus on the why and you just focus on the action, if you just focus on, I got to go to the gym, I got to go lift some weights or run on a treadmill, whatever activity is you're going to participate in, and you don't focus on the why. Well, I'm going to do this because I want to live longer and for the following reasons, or I want to look better. I want to lose 20 pounds because I want to do X, Y, and Z. I want to fit into this suit or this dress by this date for this affair. Whatever the rationale is, the why is what you need to focus on. It's not the actual activity that you are doing. Also, toast your accomplishments before you begin the goal-setting process. Goals are about the future, so why would you bother talking about the past? Because before we look forward, we want to prime our minds for success. That's why we actually start by looking back at how much we've accomplished. Doing that will often make you very enthusiastic and excited, and often pleasantly surprised at how much you actually did in the previous 12 months. And when you start your goal setting through that lens, you realize it's not crazy to say, I want to be all the way over there, wherever there is, in 12 months. It makes dreams seem more accessible. It makes the impossible seem possible. Next step is to focus on the big picture strategy. So you've sat down, you've focused on the why, you've toasted your accomplishments. Now what is the big picture? And if you've set goals before, if you've done goal setting strategies before, the big picture should be looked at in sync with what the big picture was last year. Or if you haven't done it before, what is the big picture? What is the large goal? And it can be multiple large goals, especially if you're focusing on different aspects of your life. But what is it that you're excited about heading into on a grand scale? And if you've done it in the past and you've set a big picture goal, you need to revisit it. Has it changed? Has it shifted? Perhaps you had a really successful year and you've accomplished one of your big picture goals. But the core thought here is where do you want to be this time next year? How do you want to feel? And what does it feel like to achieve that big picture goal? We spend a lot of time describing what it feels like to accomplish these things because ultimately accomplishing goals is not about having things. It's more about how those things make you feel. So again, what's the grand picture? What's the big picture? Once you're able to identify, which is critically important, identifying the true underlying goal. Again, going to the gym may not be the true goal. The true goal may be I need to get my cholesterol numbers down because I just had a grandson or granddaughter and I want to be around for that child. So the goal is not to do 10 reps of a 20-pound weight. The goal is to lower your cholesterol, and the way you're going to do it is by running on the treadmill and doing those 10 reps. Once you've got that big picture goal, that's when you want to do what a lot of people think of as goal setting, which is breaking it up into its pieces. But that's really towards the end, not towards the beginning. How are you going to accomplish that goal, and what are steps 1, 2, and 3 in order to accomplish that goal? This goes back to the conversation regarding Michael Jordan, Tiger Woods, is how are you going to accomplish that big picture goal? So what is step 1? What is step 2? What is step 3? So you can identify a clear path to goal achievement. Michael Jordan, Tiger Woods know that the goal is to win that golf tournament. The larger goal is to be, perhaps, speaking for them, can't get into their minds, but when they were in their primes, was possibly to be the greatest basketball player in the world or the greatest golfer in the world. That's the big picture. Now we're breaking it up into its pieces on how we're going to get there. Same applies, same principle applies to our lives, whatever it is that we're looking to achieve. What is step 1? What is step 2? What is step 3? So, moving from our goals to some year-end thoughts and year-end planning, something we've had previous discussions on these morning calls. December 16th today. Reminder to anyone who's out there, investors, advisors, must get required minimum distributions done by year-end if you are required to take an RMD. Most people over age 70 and a half, depending on their circumstances, but most people over age 70 and a half are required to take an RMD. If they don't take one, there's a significant penalty. Number 2, take a look at your gains and losses for year-end to do strategic planning. Lots of investors this year have very substantial gains, especially in mutual funds that they may not even realize. So if you own mutual funds in non-qualified accounts, you may have been subjected to, or you may be subjected to, capital gains distributions and dividends that could be significant, that could impact your tax planning. Make sure you take a look at that and take a look at your holistic portfolio of gains and losses and make sure that you manage those to be as tax efficient as possible. Number 3, take a look at your overall picture for the year. How much income do you anticipate having? How much taxes did you pay? Did you save enough in terms of, did you pay enough already to the government in terms of taxes? Do you owe the government money? Perhaps there are some tax strategies that you can employ to lower the amount of money that you have to pay in federal or state income taxes. One fairly obvious candidate is charitable contributions, which may allow you to take greater tax deductions. Another candidate that is common is make sure that you've been able to max out or invest as much as you can in your retirement plan, whether it's a 401k plan, a simple plan, an IRA plan. If you're eligible to invest in a Roth IRA because you meet certain income requirements, great opportunity to make that Roth investment. You do have until April 15th of next year, but doing it now while you're thinking about it is a great time to get that done. So those are just a few thoughts for year end. Don't delay. Don't put it off until December 30th because you think you've got 2 more weeks. A lot of things going on in most people's lives over the next couple of weeks. Easy to get distracted and for things to slip through the cracks. So moving on to the financial news this morning. Last week we had a lot of things go right for investors, and we had the equity markets move up, although perhaps not up as much as the good news that we received. Some speculating perhaps some of that good news was already baked into the financial cake. Nevertheless, we are seeing some strength this morning, and we saw strength last week. We saw the S&P up about 0.75%, the Dow up about 0.5%, NASDAQ up about 0.9%. Interesting, the biggest winners last week were outside the United States. Foreign stocks in developing countries were up 1.7%. Emerging markets having a very big week, up 3.63%. Year-to-date, the S&P is up 29%, the Dow up 23.5%. The NASDAQ up 33%, foreign stocks up 21%, and emerging markets up 15%. So what went right last week? Well, we had the Federal Reserve and European central banks both pledging to do what they could to underpin their respective economies. We had the United Kingdom give Boris Johnson's Conservative Party a landslide victory, virtually guaranteeing that the Brexit saga will end finally. And on Friday, we had President Trump announce that a Phase 1 deal with China had been completed, and the negotiations on a Phase 2 deal would begin immediately. Details were lacking, but it surely was good news for the financial markets. Some could argue that Christmas came early for financial investors, as wishes of greater clarity in a highly uncertain world were granted. It's interesting to note that this good news and the good news we saw last week and the good news that we've seen this year, we could attribute it to many factors, but perhaps the factor that potentially is having perhaps the greatest impact on the equity markets could be the very low interest rates. Interesting study that the Paulson Group, actually not the Paulson Group, but James Paulson, who's the chief investment strategist at the Luthold Group, came out with a study last week and studied the 10-year Treasury bond. And what the Luthold Group discussed is that the data they had was for the last 93 years, going back to the 1920s. And when investors had the opportunity to invest in stocks when the 10-year Treasury yield was below 3%, has proven to be a gift. Adding equities to a portfolio when yields are under 3% sharply boosts returns, they found, without significantly increasing overall risk. As a matter of fact, when interest rates are below 3%, the volatility on all equities has been, again, no guarantee of the future, but has been 40% lower than when yields are above 3%. And when Treasury yields are below 3%, 12-month returns were negative only 18% of the time. When bond yields rise, and they're in the range of 3 to 4%, the risk-reward ratio goes from being extremely favorable to stocks to a 50-50 trade-off between stocks and bonds. So Barrons had their headline story, which was a story regarding where stocks are headed in 2020. They had a forum with 10 senior strategists, and those strategists discussed the macroeconomic picture. And what they found was that they see, on average, a rise of 4% for the S&P in 2020. And they say, add on top of that a 2% dividend yield, and stocks could deliver a total return of about 6% next year, is what the panelists are expecting. This is meaningfully less optimistic than they were last year. The panel also said that they see U.S. gross domestic product growth slowing to an average of 1.9% in 2020 from its current estimate of 2.3% for this year. Last year, 2.9% was GDP growth and 2.4% the year before. So looking for very modest GDP growth, looking for a fairly mid to single digit return on equities, but nevertheless it's still a far cry from the recession that has been loudly and often predicted to arrive any day now. So certainly not negative, but not as bullish as we saw this year, also for sure. So moving on to another article in Barrons. Barrons every year at the end of the year comes out with their top stock picks for 2020. Give you an idea, last year's picks were up 24.6% versus the S&P at 24.3%. And give you some of the stocks in the top 10 list this year. One is Alphabet. Some people call it Google because it's the parent of Google. Alphabet recently hit a record after gaining nearly 30% in 2019. Stock trades for 25 times projected 2020 earnings of $55 a share. But its effective PE is closer to 20 after adjusting for losses in Alphabet's other bet businesses like Waymo, the leader in autonomous driving technology, and Alphabet has $117 billion net cash. Comparing Alphabet with a company like Apple, whose shares are up about 75% this year, and you'll find Alphabet, whose revenues are up about 20% this year, compared to Apple, whose sales are roughly flat, that perhaps Alphabet may be a better story in 2020. Alphabet has the global leading position in search engine. They own YouTube, they own Android, Chrome, Maps, and Waze are primary businesses for them. Also mentioned in this article, Berkshire Hathaway, which has significantly lagged behind the S&P 500 in 2019. But based on rising book value and earnings, Barrons thinks 2020 could be a year of outperformance. The Class A shares are up about 11% in 2019 against about a 29% return for the S&P 500. Berkshire is trading at about 1.3 times book value. The stock's PE ratio is about 21, which is slightly higher than the S&P, but historically is very low relative to the S&P. And Barrons feels that the valuation is understated because of Berkshire's large equity portfolio and cash position. They also speculate that Buffett is thinking big in terms of acquisitions, and they listed some possible acquisition targets like Walgreens, Delta, Southwest Airlines, FedEx, and UPS. Also mentioned in this article, Comcast, trading at around 13 times earnings, saying it's inexpensive relative to its peers. Dell Technologies, which is trading for 8 times its $6 per share expected earnings. JP Morgan analyst quoted with a overweight rating and a price target of 70 based on the sum of parts valuation. Real possible driver of valuation could be in 2021, which is still a year off, when Dell would be able to spin off and monetize the VMware stake without paying taxes, and the anticipation of that event is something that could boost the stock. Also in the article, Pfizer, they say, looks appealing. Barrons recently wrote Pfizer up as a cover story. Story here is the same as in that cover story, 6% potential annualized sales growth through 2025, the spinoff of the generic business to Mylan Labs, and the expectation that if all this comes to fruition, you could see 10% plus yearly gains in earnings per share, and you're looking at a PE in the low teens. Royal Dutch Shell next on the list. Energy sector has been the worst sector this year and the worst sector in the last 10 years. Barron's predicting the next 10 years at least could be better for Royal Dutch Shell. It trades at around 13 times earnings, discount to its U.S. peers Chevron and ExxonMobil, 6.5% dividend yield, and Chevron, Texaco, and ExxonMobil not as shareholder-friendly. Royal Dutch Shell committed to delivering significant amounts of cash to shareholders in the way of dividends. About $125 billion in dividends and stock buybacks are expected in the next 4 years, which represents about 50% of the market capitalization. Finally, mention one other, and that is Viacom CBS, another value story, another stock that has not performed well. Recent merger of CBS and Viacom create what some analysts call a content powerhouse, 20% of U.S. viewers, and a shareholder-focused management team led by an underappreciated CEO, Bob Bakish. Stock's at around 38, trades at around $6 a share. In contrast to industry leader Disney, which is up 34% this year, CBS Viacom having negative returns in 2019. CBS Viacom's market cap, $23 billion. That's 10% of Disney's, and it also trades at a third of Disney's PE as well. Investors are worried about the impact of cord cutting, rising program expenses, competition from streaming services like Netflix and Disney, and the potential high cost to renew the CBS NFL contract, which is up for renewal in 2023. Nevertheless, these concerns seem well discounted in the stock price, the article concludes, and the company is expected to be a large buyer of its shares in coming years. So moving on to the bond market, one is article in Barrons talking about the energy stocks and the companies, especially those that have been involved in drilling for oil and gas, also known as the shale revolution here in the United States. And the article talks about that the shale revolution was largely successful on the back of easy money, where companies that did oil and gas production via shale technology were able to access the capital markets to borrow money, and therefore they've got lots of debt that is outstanding. Barrons is concerned about the ability of these companies to be able to refinance that debt as it comes due over the next several years. They point out, and they say justifiably so, that the energy market in the high-yield space, or the high-yield energy sector, is perhaps the worst performing sector in high yield this year, in a year in which high yield performed well. It's down 5% year to date, and Barrons is concerned that that weak performance not only will continue, but potentially could get worse. They point out that equity infusions have dried up. Lenders are getting very picky on who they're willing to lend to in the space, and starting in 2020, companies in the oil and exploration space here have a wall of debt totaling $71 billion maturing over the next 7 years, and one or two failures could beget more failures within the space. So they suggest significant caution when it comes to the shale drillers and the energy space here in the United States. Something to think about when you look at individual bonds or bond funds or ETFs of bonds and see what the composition of those portfolios are and why perhaps you're getting a higher yield than elsewhere, and see if that higher yield is justified in the long run. Finally, on the municipal bond space, in the Bloomberg brief, for those of you who are New York investors, New York right now has one of its largest deficits ever, $6.1 billion deficit, which Bloomberg is suggesting that Governor Cuomo was caught off guard, and there is this big hole in the state budget, and it was caused mostly by rising Medicaid costs. And if the current spending trends continue, the state, which is New York, could face an $8.5 billion deficit in 2023, of which about half would be for Medicaid. Cuomo's office says it's looking for savings. They attribute the rise of this deficit to a couple of factors. The largest is the increase of the minimum wage to $15 an hour. So critics are pointing out this was a policy advocated by the governor, so the governor should have anticipated the impact this would have on the state's budget. Also impacting the state is a significant increase of Medicaid recipients who are enrolling in long-term care as people live longer. And New York is also receiving less in federal aid as a result of some changes that were implemented by the Trump administration in terms of redistributing funds to the states. Moody's did describe the situation as a credit negative. However, at this time, they've chosen to keep their stable AA1 rating on the state, but it is something to be watchful and mindful of and aware of as you focus on investments in the municipal space. With that, I'm going to turn things over to Brad, talk some more about the bond markets. Good morning, Brad.
Morning, Keith. Before I start, I just want to comment on Keith's comment about the Bloomberg brief with the New York finances. These are the kind of things that we're looking for every day. My personal Bible for all things New York finance is the New York Post. They come out weeks ahead of time with the stories about the problems with the potential budget deficits and spending problems. So this is something that we'll always monitor. We do trade a lot of New York municipal bonds, and it's something that we really have to stay on top of to make sure that it doesn't get to a point where we wake up one morning and we're really in trouble. I don't think that we are going to be there for the time being. Still have strong markets and some other things that are helping New York State along, but it'll certainly be monitored. On a general note, just a recap of the year. It was just a very strange year to watch the bond market and the stock market rally in such a big way on both fronts. The 10-year Treasury went from about 2.6% at the beginning of the year all the way down to about 1.5%. We're at about a 1.85 now. And the stock market, everybody knows what the stock market did. A broken clock's right twice a day, and I'm expecting to be that broken clock. I think something has to give. One of these markets is right, and one of them are wrong. And I don't know when or how or why this will happen, but in my 30-year history, at some point, one of the markets is given, and we'll see which one it is. And I'm not predicting which one it is, but that being said, you want to make sure that you are balanced, that you are defensive. Something I've been pointing out all year is stay with high credit quality in municipals. You see what's going on in New York now. If you own Great Neck, you own Scarsdale, you're not really involved in this in the credit of New York, so to speak. The other things that you should be looking at are higher coupon bonds, shorter calls, take a little bit of volatility out of any major market movement to the downside, meaning rates to the upside. And you just want to be able to protect yourself and make sure that the bond part of the portfolio is doing what it should be doing at this particular point, which is a hedge of some form, or a portion of a balanced account. This isn't the type of market, in my opinion, that you're looking for real growth from bonds. So anyway, thanks, and I hope everyone has a great, healthy, and happy New Year, and I'll see you all soon.
Thanks, Brad. Yeah, I want to emphasize the value that we get to benefit from Brad, his knowledge and expertise in the municipal space, pointing out the constant monitoring of situations like New York and getting ahead of those is really something that distinguishes our firm from others. And Brad, I know personally, spends lots of time thinking about what's the best value in the municipal market and thinking about what positions to recommend that advisors take a look at. Also, the futures this morning are moving higher. We're seeing S&P futures up about 19 points, NASDAQ futures up just a little over 50, Dow futures are up 90, and that's despite the fact that Boeing is weighing pretty heavily on the Dow futures because they are talking about possibly cutting back or halting production of the 737 MAX in the wake of further delays in terms of getting that plane back on track. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.